Equities are also referred to as stocks and shares. For the sake of our studies, we'll use them as interchangeable terms. When you buy a share, you're taking ownership of a small part of a particular company. If the company declares them, you receive dividends as a result.
What is a dividend?
Good question. The purpose of a company is to make a profit for its shareholders. The dividend is the way a company pays out its profits to shareholders. Think of a dividend as a financial reward for taking the risk of owning a share.
Is that the only way I can make money from owning company shares?
No, all public companies have a quoted share price. This is the cost to you to buy one share. If you own a share and the price goes up, when you sell, you will make a profit. In order to explain how stock trading works, we'll use a simple example. British Petroleum plc, or BP as it's more commonly known, is a huge oil company with about 20 billion shares. Let's say each share is currently worth £5. This gives a company an equity value or market capitalization of £100 billion. Now, let's say that you think the value of the company will go up and you buy 100 shares for £500 in total. Well, congratulations, you are the proud owner of a 0.0000005% of the company. And say that a month later, the share price has gone up to £5.50. This means that the total equity value has gone up to £110 billion and your portion to £550. You sell 100 shares and taxes and commission aside, you have made £50.
Well, this sounds fairly straightforward. But share prices don't always go up, do they? What happens if they go down?
That's right. Share prices can go down as well as up. If BP's share price had gone down to £4.50 and you had sold, you would have lost £50. For that reason, it's incredibly important to analyze the company you're trading. We'll cover the different types of analysis later in this course.
Understood.
That just about wraps up our example on shares.
Assalamualaikum warahmatullahi wabarakatuh to all my friends and my lecturer, that is Nadaminda. Today, my group, that is Group 1, would like to present to you our topic, that is equity markets. Okay, first, my name is Sharifah Nur Ainatira binti Said Musaifuddin. My metric number is 20BP05011.
Assalamualaikum warahmatullahi wabarakatuh. My name is Wan Muhammad Isranu. I'm Biwan Ismail. My metric number 18BB04024.
Okay, let's go to the next slide. There is table of content. We have 5 topics that we want to present to you. That there is first is introduction, second is instrument of equity market and instrument of Islamic equity market, third is example real product, fourth is debts vs equity, and the last is equity from the light of Maqasid Sharia. Okay, we go to the first slide. There is introduction. In introduction, we also conclude the development of equity market in Malaysia and equity market index in Malaysia. Okay, first thing first, it is important to begin with a good understanding of what is equity market in the context. Equity market, often called as stock market or share market, it is the location where stocks are traded by companies or individuals. The market allows sellers and buyers to deal in equity or stocks in the same platform. Equity or stocks represent a share of ownership of a company. There is virtually no difference between stock and equity. These two words are commonly used to mean shares. Stock and equity are just synonyms. Equity share trading is done via online equity trading systems. The development of equity market in Malaysia. The Malaysian stock Exchange enjoys a diverse investor pool with strong support from domestic institutional investors, domestic retail investors, and just under 25% investors reflect foreign institutional investors. Total market capitalization from the Malaysian Stock Exchange is at 1.711 billion as of December 2019, with Sharia-compliant companies account for 77% of the total Malaysian market capitalization according to Bursa Malaysia. A large number of Malaysian listed companies have established themselves regionally and globally through organic growth and strategic acquisitions. The top performing list companies are from industries such as finance, telecommunications, healthcare, transportation, and agriculture. Today, Bursa Malaysia is one of the largest bourses in ASEAN with over 900 listed companies. These products include equities, derivatives, exchange-traded funds, ETFs, real estate investment trusts, REITs, and unit trusts. Next, you can see the Malaysian Stock Exchange has three main markets. First, there is main board. It's a prime market for larger companies with strong track record of operations and profitability and are able to demonstrate a minimum size measured by market capitalization. Second, there is SE board. It's a sponsor-driven market designed for smaller companies that may have a shorter period of track record but record strong growth prospects. Lastly, the LEAP board, which was introduced in 2017, is an advisor-driven market which enables emerging small and medium-sized enterprises with greater fundraising access and visibility via public markets. Next, we go to the View Malaysia's Equity Market Index from February 2020 to January 2021 in the chart. In the chart, we can see Malaysia Composite closed at 1,566.4 points in January 2021 compared with 1,627.2 points at the previous month end. Composite data is updated monthly, available from February 2020 to January 2021 with an average number of 1,534.52 points. The data reached an all-time high of 1,627.210 points in December 2020 and a record low of 1,350.890 points in March 2020. Bursa Malaysia provides the FTSE Bursa Malaysia Index series, which consists of 6 tradable indices and 7 benchmark indices, but the Kuala Lumpur Composite Index is the one most closely monitored by analysts. Okay, next we go to equity instruments, which is like instrument of conventional equity. Okay. And equity instruments refers to a document which serves as a legally applicable evidence of the ownership right in the firm, like a share certificate. Equity instruments also are generally issued to company shareholders and are used to fund the business. However, it is not necessary that the issued equity must return a dividend, for it is based on profits and the terms of business. Okay, next, the equity instruments can be divided into numerous categories, which the most common ones being common stock. A common stock is equity instruments represent ownership in the company that issued by the public company to raise funds from the public. The buyers of common stock are referred to as shareholders. The shareholders have the privilege of being entitled to co-ownership of the company, in addition to having the right to vote at the shareholders meeting as per the proportion of shares. Besides, they also have rights to take decisions in important issues like raising capital to pay dividends and merging business. Moreover, the shareholders can also apply new shares when the company has increased capital or issues like a new allocation for the shareholders. So now, we go to the types of common stocks associated with the underlying company. First, there is blue chip stocks. Blue chip stocks refers to companies with a long history of sustained earnings and dividend payments. These established companies have developed leadership position in their respective industries and, because of their importance and large size, have stable earnings and dividend records. These types of companies tend to be less risky in periods of economic uncertainty because of their dependable earnings. Besides, investors are attracted to blue chip stocks because they not only provide a store of wealth in anticipation of capital appreciation, but also deliver regular dividend income. Second, there is growth stocks. Growth stocks are issued by companies that expected to have sustained high rates of growth in sales and earnings. These companies generally have high price or earnings PE ratios and do not pay dividends. These companies' earnings are growing faster than the overall economy, and thus the stock has a strong potential for outperforming the market. Besides, investors do not receive return in the form of dividends, so they buy these stocks for their potential capital appreciation. So it seems like blue chip stocks, just in the blue chip stocks, they will deliver a regular dividend income, but in this stock they will not get because they do not pay the dividends. Third, there's emerging growth industry. There's a young firm in new industry with a good growth prospects but also high risk. Last, there is income stocks. Income stocks have high dividend payouts, and the companies are typically in the mature stages of their industry life cycles. Stocks of companies have established a pattern of paying higher than average dividends can be defined as income stocks. Income stocks tend not to appreciate in price as much as blue chip stocks do because income stock companies are more mature and are not growing as quickly as blue chip companies. This statement does not mean that income stock companies are not profitable or are about to go out of business. On the contrary, they have stable earnings and cash flow, but they choose to pay out much higher ratios of their earnings in dividends than other companies do. Next, there is types of common stock associated with the characteristic of the industry. First, there is cyclical stocks. Cyclical stocks move with the broader market and often with greater volatility, so they can outpace the market during an expansion but withdraw back during a contraction. For example, there is automotive stocks, and automotive stocks are like car brands such as Ferrari, Volkswagen, and many more. Second, there are counter-cyclical, or can call it defensive stocks. In these stocks, they do better in bear markets when the investors are looking for safe places, so they are not affected greatly by economic currents to park their money. Companies in the food, healthcare, and defense industries are all examples. And third, there is speculative or special situation stocks. In the stocks, for those in whatever reasons, and an investor believes its stocks will rise quickly in market price. Next, there is the advantages of investing in common stock. Common stock have the advantage of offering a high current income. Compared to bonds or certificate of deposits, they provide a better opportunity to make a larger return on investment. These under-investment are guaranteed, so you know the minimum and maximum amount that you stand to gain from them. However, common stock have no limit. While this means that you will lose money, but it also means that there is no limit to how much you can gain money. Second, there is higher rate of return. Equity ownership provides Second, there is higher rate of return. Equity ownership provides the highest rate of return in the long run, more than bonds and cash, while common stocks have provided over a 6% real rate of return in the long run, which is providing one of the best means to stay ahead of inflation. Next, the advantages of investing in common stock is it will low unit cost, and last, it will less risky due to its position during liquidation. So when you purchase a common stock in a company, then your personal assets are not at risk if the organization get into legal trouble. So that's good news for you. If the stocks goes bad and the business ends up owing creditor a lot of money or faces significant judgment, although you will be out of money that you put in the business, the loss could be something that helps you when you file your taxes for that year. Okay, next, the disadvantages of investing in common stock. The common stock shares are the most pervasive type of equity investment that are available, but there is a downside to holding this type of share that can make the asset class less appealing than the other types of investment. So, the first point of the disadvantages of common stock is you are the last person to get paid during a company liquidation.
Okay, now I would like to explain about the preferred stock. What is actually preferred stock? Preferred stock is a share that does not give a right to be shareholders to vote at its general meeting or any rights to participate in any distribution of the company that has stated the amount, whether through dividends, redemptions, dissolutions, or otherwise. A preferred stock also have several types of preferred stock, which is cumulative preferred, non-cumulative preferred, participating preferred, and convertible preferred. Okay, what can I explain about the type of the preferred stock? Holder of cumulative preferred shares are entitled to the received dividends retroactively for any dividends that were not paid in periods, whereas non-cumulative preferred share does not carry this provision. For this reason, cumulative preferred share will generally be more expensive than non-cumulative preferreds. Similarly, participating preferred shares offer the benefit of additional dividends if certain performance targets are reached, such as company profits exceeding a specific level. Convertible preferred, like convertible bonds, allow the holder to convert their. Okay, this is the characteristic of preferred stock, which is limited voting rights, second call provision, and the last one conversion feature. Okay, the explanation about the characteristic preferred stock, where the preferred shares usually do not carry voting rights, although under some agreements These rights may revert to shareholders that have not received their dividend. If shares are callable, the issuer can purchase them back at par value after a set date. If interest rates fall, for example, and the dividend yield does not have to be as high to be attractive, the company may call its shares and issue another series with lower yield. And the last explanation, some preferred stock is convertible, meaning it can be exchanged for a given number of common shares under certain circumstances. Okay, this is the advantages and disadvantages of investing in preferred stock. Okay, for the first advantages, some business pay regular quarterly dividends out of after tax profit to common shareholders. Second, online brokers make trading stocks on major exchange easy and inexpensive. And last, for qualifying stocks, brokers allow margin trading and short selling. For the disadvantages, first, companies are not allowed to pay dividends to their common shareholders in bankruptcy proceedings. Second, investors are at risk of locking down losses on thinly traded stocks, especially in fast-moving markets. And the last one, two strategies to protect equity. Portfolios from downside risks are diversifications and hedging. In the Islamic equities market, in the case of Sharia, equity financing will be the preferred method of investing or financing. The equity financing does not have a fixed return. The returns that are related to the underlying company's earnings, a risk profile that is not detached from that of a business. Equity investment is also a great deal of benefit and loss sharing and all the market risk thrown in. Investment in stock resembles the provision of finance from Mudharabah. Later, I will explain more about the Mudharabah.
Okay, next we go to the instrument of Islamic equity. Definition of document that Islamic equity use is same with the conventional equity, but its types is different. In Islamic instruments equity, there use three types of Islamic instrument, which is unit trust, REITs, and ETFs. First, we go to unit trust. Unit trust is an unincorporated mutual fund structure that allows funds to hold assets and pass profits through to the individual owners, rather than reinvesting them back into the fund. The investment fund is set up under a trust deed. The investor is effectively the beneficiary under the trust. Okay, next is hybrid REITs. Hybrid REITs combine the investment strategies of equity REITs and mortgage REITs by investing in both properties and mortgage. Okay, last is ETFs. ETFs are security that tracks an index, a commodity, or a basket of assets like an index fund, but trades like a stock or on an exchange. ETFs experience price changes throughout the day as they are bought and sold. So I will pass to my friend to continue our presentation.
Types of ETFs. Here are a few of the most common types. Stock ETF. Stock ETFs track a particular set of stocks. They can track these equities based on their index or industry. Because stocks are subject to market volatility, this can be a good option for long-term investors. since a longer investment horizon allows securities more time to recover should the market see a periodic downturn. Bond ETFs may be attractive for investors interested in fixed income ETFs. This is because they pay regular interest dividends from corporate or government bonds. Bonds are typically a less risky investment. Commodity ETF. This ETF invests in commodities like precious metal, agriculture goods, or natural resources. Sector or industry ETF. These ETF track particular industries like biotech, healthcare, energy, etc. Currency ETF. Currency ETFs trade foreign currencies and can provide investors in exposure to the forex market. Leverage ETF. Leverage ETFs aim to amplify returns, typically by 2 or 3 times more than that of a typical ETF tracking the same index. They are most often used as a short-term investment strategy. While they can provide significant returns when the underlying index is on the rise, losses are also magnified, making them a higher risk investment. For the last, inverse ETF, also known as short ETFs or bear ETFs. Inverse ETFs aim to deliver returns on the decline of the indexes they track, meaning if the underlying index decreases by 1%, the inverse ETF increase by 1%. Like leverage ETFs, they are often a short-term investment and can result in significant losses should the market fluctuate. The table below summarizes the key sources of differences for these investment products, how they are sold, and how they are managed. In practice, these differences typically lead to the dissimilar overall returns. How? It comes down to the structure, how they are managed, and the associated costs. Key differences between ETFs and unit trusts. Buy or sell for ETF, traded on a public market. Unit trust, sold through private channels. Management type for ETF, passively managed. For unit trust, actively managed. Liquidity for ETF, highly liquid, can be bought or sold like a stock. For unit trust, not very liquid, high fees, and limited buying and selling. Asset class composition for ETF, constrained to asset class. For unit trust, can have diversified asset classes. Annual fees for ETF 0.05% until 0.7%. For unit trust 1.5%, which is median. Entry fees for ETF, if purchased through a broker, 30 to 6 Malaysian ringgit per trade. For unit trust, 0 until 5%.
Okay, now I explain back what are REITs. A REIT is a short form for real estate investment trust that allow individuals to invest in income to producing real estate without the expense of purchasing and maintaining actual property. REITs typically specialize in the type of real property such as residential apartments, retail centers, office buildings, industrial complexes, healthcare facilities, and warehouses. Okay, now we go to the type of REITs. There are two types of REITs, which is equity REITs, mortgage REITs, and hybrid REITs. First, we go to equity REITs. Equity REITs is operate and manage income producing property. This is the most popular type of REITs and usually earns income from rents. Next, there is mortgage REITs. Mortgage REITs lend money to property owners and operate like a mortgage. Mortgage REITs can also acquire mortgage-backed securities. Unlike equity REITs that earn money from activities associated with commercial property, mortgage REITs earn money from interest on the money lent to the property owners. The last one is hybrid REITs. Hybrid REITs diversify their portfolio by investing in both equity REITs and mortgage REITs. The incomes for hybrid REITs comes from both rent and interest.
How can I get started investing in REITs, or as we know, as real estate investment trust? You can get started investing in REITs pretty much the same way you do invest in any other fund or company stock. Here are the easiest ways that you can get started. First, purchase publicly listed REIT stock. As noted earlier, many REIT stocks are publicly listed. That means you can buy shares directly from the stock exchange using an app or a website that allows you to buy stocks. This can be intimidating for some beginner investors, as there is no middleman and no expert guidance on what companies are smartest to invest in. Second, invest with broker. Brokers are professionals who handle investment portfolios for consumers. They should know exactly how to tailor your portfolio, your specific goals, needs, and risk tolerance. If you think REITs are a good option for your portfolio, talk to your broker about it. Or if you don't have one, find a broker in your area and say you want to get started investing and you think REITs could be a good option for you. Many robot investors also allow you to invest in REITs or simply do it automatically depending on the portfolio option you select when making your account. Third, through your retirement account. If you have a retirement account like a target date fund, IRA or 401k, there's a chance that you are already invested in REITs without knowing it. Because, as we noted earlier, REITs performance is not always correlated with other sectors of the market. They make for a solid diversifying option to keep your portfolio balanced. Getting started investing in any area can be challenging. However, being informed is the best first step you can take. Once you feel comfortable, if your knowledge of real estate investment trusts and how they work, you can start seriously thinking about investing.
Okay, this is for the example of the product. For example, the product, there are two types, which is Islamic capital market products and conventional capital market products. For Islamic capital market products, a wide range which include Sukuk, Sharia, company equities, the Islamic funds, equity funds, Islamic exchanges traded funds, IETFs, and last one, real estate investment trust, which is IREITS. Okay, for conventional capital market products, there are three things. First, equities. Second, derivatives, swap, option, future forward, and the last one is bonds. Okay, next, for the second slide, what is debt versus equity? First, what is debt? Debt financing involves borrowing funds from investors by issuing corporate bonds. The company has to return the principal amount along with the interest. Loan interest payments are tax deductible and the company does not part with the ownership rights. Ensures that they will receive a fixed amount of income for a specific time period. Okay, this explains if the company have been paid interest of loan, it might be also a deduction in tax payment. Then the borrower will get the amount of money and need to settle down the loan payment. Okay, what is equity financing? Equity financing involves selling the part of ownership rights in the company to investors by issuing stocks. Equity financing involves investor giving capital to promising business, startup or companies. Investors do not receive a fixed income like in the case of debt financing. Businesses favor equity financing because they are not lawfully accountable. Equity financing giving the capital or help the company in terms of marketing. Okay, next, equity from the light of Maqasid Sharia. The purpose of the Sharia is to benefit and protect mankind, which is it means that the Sharia would like to protect the borrower. Al-Ghazali classified Maqasid rank into three. First, Daruriyah, second, Hajjah, and the last one is Tahsiniyah. The Daruriyah are divided into five, which are life, intellect, faith, lineage, and property. Second, the Hajjah seek to protect and promote the first category. And the last one, the Tahsiniyah, are refinements in society. For example, the encouragement for the wearing of perfume to the Friday prayer. The Sharia also encourages good conduct in men's behavior. For example, ihsan, gentleness and pleasant speech. The significance of equity and justice. Establishment of justice is one of the three pillars of objective of Sharia for achieving sustainable economic development because everyone has the same opportunities. Equity gives equal financing opportunities to all, whether rich or poor. In the eyes of Allah, a rich man and poor man are equal, and the only thing that distinguishes them is taqwa or pity. The fulfillment of justice can bring social and moral uplift in the society. The ideal Islamic banking and finance from Maqasid Sharia perspective. Based on the aforementioned facts regarding the bad evil in debt-based financing, it is important for Islamic banking and finance hold on Maqasid Sharia. The noble vision to promote social welfare of the society is in need to develop a welfare economics-oriented paradigm. Even non-Muslim scholars such as Rodney Wilson 2005 are proponents of equity financing. Equity financing can be conducted in a very moral manner. Principles of risk sharing and cooperation through participation certainly preferable to conflict of interest. This means Maqasid Sharia do really protect the borrower based what the Rodney Wilson mentioned about it. For the conclusion, the Islamic capital market has been established to play a complementary role to the Islamic financial system in developing and expanding the market for Islamic financing in Malaysia. The government's efforts are often in developing Islamic capital market system is also important to meet the demand a fund based on Islamic Sharia law, which is gaining ground among investors now. However, both the capital market, either conventional or Islamic, is important in the Malaysia capital markets, as shown by the diversity of the company. However, both the capital market, either conventional or Islamic, is important in the Malaysian capital market, as shown by the diversity of the community.
Forgotten blessings, barakah in money. Barakah is a divine blessing from Allah subhanahu wa ta'ala that impacts everything in our life in unseen ways. Recently, a friend of mine asked an audience to ponder over the difference between monopoly money and real money, and if anyone would accept monopoly money in real trade. Of course, the answer is no. We all want real money, dollars, etc. But not all money is the same. Just as monopoly money cannot be traded in place of real money, money that has no barakah cannot replace money which has it. When money is earned from impure ways, it loses its blessings. With no barakah in our money, things we buy will be void of those blessings. So when we, for instance, buy food with that money and our kids start eating from it, and then we ask ourselves, why don't they listen to us? Why don't they pray? Why are they like this? It is perhaps that what they are getting is not 100% halal and does not have barakah. How to increase barakah? Part of increasing our barakah is by earning halal income while keeping Allah's commandments and avoiding His prohibitions. Honesty brings blessings while sins and wrongdoing diminish it. The Messenger of Allah sallallahu alaihi wasallam said, if parties in a business transaction speak the truth and make everything clear, they will be blessed in their transaction. And if they tell a lie or conceal anything, the blessing on their transaction will be removed. He sallallahu alaihi wasallam also said, beware of swearing oaths when selling, for it may help you to make a sale, but it can destroy the blessing. Therefore, when Allah wants good for His slave, He puts barakah into his wealth, even if his wealth is little. And when this blessing is withdrawn, one will not enjoy what he has from wealth, even if he has much of it. So what is barakah? Barakah is divine blessing, which, if present, provides increased growth and good results, even from the smallest amount of money. And though this cannot be calculated in material terms, it makes your wealth go a long way. When these blessings continue and grow, we call it barakah.